Ladies and gentlemen, thank you for joining me today. I want to begin with a bold statement: by the year 2030, everything will change. I don't mean slight tweaks or gradual evolution. I mean a reimagining of industries, of societies, of opportunity itself. Over the next decade, we stand at the threshold of a transformation so profound that the world we survey today will look astonishingly different to the one we inhabit in 8 years. Every time innovation redefines the global economy, it challenges the old systems we once trusted. Today, one of those systems is the reliance on a single currency. For decades, the world has moved in lockstep with the dominance of one financial instrument, believing its strength would remain unshaken. But history tells us otherwise. Every monetary era ends when technology, policy, and behavior evolve beyond its limits. We are witnessing that transition again right now. The belief that one currency can remain the world's anchor forever is built on a linear mindset. Yet the forces reshaping our world are exponential. Digitalization, decentralization, and demographic shifts are eroding the foundations of centralized monetary control. As value moves faster and across borders, the need for flexible, open, and technologically adaptive systems becomes undeniable. We are moving toward an era where money itself is being redefined, not by governments alone, but by innovation, transparency, and trustless networks that cannot be printed or manipulated. When you observe the data, the cracks are already visible. Inflationary policies, mounting debt levels, and the rise of digital assets are converging in ways that signal a new financial order. The purchasing power of traditional currencies continues to erode, and people are quietly seeking alternatives, assets that can preserve value in a world that is changing faster than central banks can respond. This isn't speculation, it's adaptation. The market is signaling that confidence is shifting from paper promises to verifiable systems of value. In past decades, diversification was about owning stocks and bonds. In the coming decade, it's about diversifying where and how we hold value, whether through blockchain-based assets, tokenized real-world goods, or other innovation-led instruments. The goal remains the same: resilience. Those who understand monetary history recognize that each new age of innovation births a new financial framework. The printing press, the Industrial Revolution, and the rise of the Internet all redefined what people trusted with their wealth. This time is no different, except the speed of transformation is unmatched. The next global economy will not be built around a single reserve unit. It will operate on networks that are open, digital, and accessible to anyone with a connection. In this environment, competition will push currencies to evolve or fade. Power will move from those who control issuance to those who innovate in transparency and utility. The transition won't be without volatility. Change never is. But the destination is clear. A system built on technology will outperform one built on policy. The message is simple: don't anchor your future to one monetary regime. The rules that governed the past are not the same rules that will guide the next decade. What appears stable today may be the very structure that limits tomorrow's growth. Those who remain open to evolution, who see beyond borders and into systems of innovation, will not just preserve their value, they will amplify it. The age of financial transformation is here, and those who prepare will lead it. In a world increasingly defined by data, algorithms, and virtual transactions, the importance of owning what is tangible and enduring is quietly returning. The digital economy has expanded our reach, yet it has also reminded us of something fundamental: real value is created by real things. The market cycles may fluctuate, currencies may lose purchasing power, but assets rooted in innovation, production, and scarcity maintain their strength through every phase of disruption. Throughout history, progress has always rewarded those who owned what others relied upon. In the industrial era, it was factories and infrastructure. In the information age, it became networks, data, and intellectual property. Now, as the world transitions into a new technological cycle, the definition of real things is evolving again. It's no longer limited to physical commodities or property. It includes ownership in the technologies building the future: renewable energy, artificial intelligence, robotics, genomic innovation, and digital assets that represent real utility rather than speculation. Every time the world changes, it tests what we truly understand about value. Paper promises can disappear, policies can shift overnight, but real ownership of assets, innovation, or production capacity stands independent of manipulation. The strength of owning real things lies in the control it offers. When you own something that generates utility, that drives productivity, or that solves real-world problems, you are aligned with the structural growth of the global economy, not just its financial surface. We are moving into an age where tangible ownership and digital proof of value are converging. Tokenized assets, decentralized systems, and open-source platforms are creating a new form of ownership, programmable, transparent, and global. This shift is not abstract. It is the natural progression of how technology reshapes trust and exchange. The key insight is that real value is not about appearance, it is about function. What can produce, sustain, and scale will always outlast what merely trades on sentiment. Owning real things is not about resisting change, it's about embracing it wisely. Innovation doesn't eliminate tangible value, it enhances it. A solar farm, a battery system, a breakthrough in gene sequencing, or an AI model trained on unique data. All of these are real in the most fundamental sense because they create measurable impact, they generate productivity, they solve inefficiencies, and they carry intrinsic worth beyond price speculation. As the decade unfolds, volatility will continue to test conviction, but those who understand that real ownership is the foundation of resilience will navigate uncertainty with clarity. The world can shift, markets can rotate, narratives can change, yet real assets tied to real innovation remain the anchor of long-term growth. In an economy driven by speed and sentiment, true wealth lies not in what fluctuates quickly, but in what endures quietly. Own what is real, because the next transformation won't reward illusion, it will reward substance. Every cycle of innovation challenges the assumption that stability comes from familiarity. In reality, stability comes from adaptability. Diversification is not about spreading resources randomly. It's about understanding where value is emerging and positioning across multiple waves of innovation. The world is no longer linear, and neither is opportunity. The speed of technological change, the volatility of markets, and the constant shifts in policy demand that we think in terms of resilience, not prediction. Diversification is how that resilience is built. In past decades, investors could afford to hold narrow positions because the world moved slowly. Today, innovation crosses sectors, geographies, and technologies all at once. Artificial intelligence feeds into robotics, energy storage connects with transportation, and genomics reshapes healthcare. Each platform influences the others, accelerating progress exponentially. To place confidence in a single theme, a single asset, or a single region is to misunderstand the interconnectedness of this new era. The convergence of innovation means that diversification is not just financial, it's strategic. True diversification begins with understanding disruption. It's not about owning a little of everything, it's about owning exposure to the future from multiple directions. When cost curves are collapsing across several technologies simultaneously, the potential for growth expands, but so does the range of unknowns. By diversifying intelligently, we embrace uncertainty as part of innovation's design. This isn't about fear, it's about acknowledging that exponential change rarely moves in straight lines. The data tells us that new market leaders often emerge from places few expect. A decade ago, electric vehicles were dismissed as niche. Now they are redefining the global auto industry. Renewable energy, once dependent on subsidies, has become cost competitive through technological progress. These shifts reveal that concentration in what feels safe can quietly become exposure to what is obsolete. Diversification protects against that illusion. It ensures that when one sector faces headwinds, another is capturing tailwinds from technological momentum. At its core, diversification is conviction in progress itself. It is the belief that innovation does not happen in isolation and that the next decade will reward adaptability more than certainty. The greatest risks are not taken by those who diversify, but by those who assume the world will remain predictable. When new technologies converge, old models of success can unravel quickly. Protecting capital in this environment means aligning with change, not resisting it. The next generation of growth will not come from a single idea or company, it will come from a network of breakthroughs reinforcing one another. Those who diversify across these frontiers will capture the compounding benefits of innovation while reducing exposure to its volatility. The goal is not to avoid risk, but to structure it intelligently. Because in an exponential world, protection is not about standing still. It's about moving in sync with transformation. Diversification is the discipline that makes that possible. Every era feels permanent until it ends. The patterns of history remind us that progress is never a straight line. It moves in waves, cycles of innovation, expansion, correction, and renewal. Those who think only in the short term see the noise. Those who understand long-term cycles see the structure underneath. The greatest opportunities emerge not when everything feels certain, but when the next cycle quietly begins while most people are still looking backward. We are now living through one of those turning points. Technology is accelerating at a rate few can fully comprehend, yet markets and institutions still respond as if the old frameworks apply. They don't. The last major cycle, defined by globalization, industrial efficiency, and monetary expansion, is giving way to one driven by innovation, decentralization, and exponential technologies. Understanding that transition requires perspective, patience, and a willingness to look beyond headlines and quarterly data. Long-term cycles are not measured in days or months, they're measured in decades of transformation. The world is shifting from an era of physical capital dominance to one where intellectual and technological capital define value creation. Artificial intelligence, energy storage, robotics, blockchain, and genomics are not isolated trends. They are interdependent forces forming the foundation of the next economic cycle. The last time we saw a convergence this powerful was during the late 19th century with the emergence of electricity, the telephone, and the automobile. Each of those technologies rewired how societies functioned. Today's innovations are doing the same, only faster and on a global scale. Thinking long-term requires a willingness to challenge short-term pessimism. Every major breakthrough has been born in times of uncertainty. The internet in the early 2000s, renewable energy in the 2010s, and digital finance after the 2008 crisis, each emerged stronger after a period of doubt and consolidation. These moments test conviction. But conviction, when grounded in data and understanding of cycles, becomes an extraordinary advantage. The majority often retreats when volatility rises. Visionaries lean in, recognizing that downturns are the incubation periods of future growth. The structure of long-term cycles also teaches humility. There are moments when technology races ahead of regulation, when valuations overextend beyond fundamentals, and when optimism turns to complacency. These are natural phases, not failures. Every innovation-driven cycle overshoots before stabilizing and compounding. The key is not to avoid volatility, but to understand its rhythm. The innovators who stay focused through the troughs build the foundations of the next wave. The investors who think long-term align with these cycles instead of being trapped by them. Economic history shows that productivity-driven transformations often take a decade or more to fully express their impact. During that time, narratives shift, institutions evolve, and new leaders emerge. The breakthroughs that seem speculative in one cycle often become indispensable in the next. That's why long-term thinking isn't about prediction. It's about positioning. When you recognize where the momentum of progress is moving, you can endure short-term dislocation with confidence. Right now, the forces shaping the next cycle are already visible. The cost declines in energy storage are driving the electrification of everything. Artificial intelligence is unlocking efficiency gains across industries. Genomic sequencing is transforming medicine into a data science. These are not distant possibilities. They are the structural shifts that will define economic growth through 2030 and beyond. The challenge is that the human mind tends to overestimate what can happen in a year, but underestimate what can happen in 10. The market, too, is often trapped in this short-term bias. Those who think in long-term cycles understand that compounding innovation will redefine value faster than traditional metrics can capture. They see beyond immediate noise and recognize that technology adoption follows predictable S-curves, slow at first, then suddenly exponential. The turning point we are approaching is one of those inflection moments. Productivity, growth, and opportunity are preparing to accelerate in ways that will surprise even the optimists. So when uncertainty rises and narratives turn fearful, remember what the data reveals. Cycles repeat, but innovation progresses. The future rarely rewards reaction, it rewards preparation. Thinking long-term is not an act of patience, it's an act of insight. It allows you to look past volatility and see direction. Every major transformation feels chaotic while it's unfolding, but history always shows that the greatest wealth and progress are built during these very moments. The next decade will test conviction, discipline, and perspective, but for those who understand long-term cycles, it will also unlock extraordinary opportunity. The key is to align with progress, not emotion, with data, not noise, with innovation, not inertia. The world is resetting for the next great expansion, one built on ideas, intelligence, and interconnection. Those who think in years will react. Those who think in cycles will lead.